Welcome to TheoTrade. This is Don Kaufman. You are watching the Theo Weekend Update for September 28th, 2018. Yes, we are recording this on a Friday evening. We have actually quite a bit to discuss with you here. Let's get to it. First and foremost, the chart that you're looking at right now happens to be specific to the S&P futures. I just wanted to give you a feel really for, this is a 30-day 1 hour, but really breaking down the entire week kind of at large. The week itself, what do we get? Again, just wild sector rotations. Now, I don't want to go too deep into this because I'm going to display something else here momentarily, but there's one point that I would like to make before I get into a little bit of a presentation here on this kind of weekend's update, and that's this. Let's highlight a couple of key aspects. First of all, at the end of the trading session here on Friday, the S&P's finished, again, $1.75. I mean, come on, people, that's what we term massively unchanged. On a Friday afternoon, we had not much action in the Nasdaq. I mean, broadly across the board, kind of finished on the Friday unchanged. Volatility didn't really back off. But the point that's worth mentioning here is that, well, people, we finished rather unchanged, but you had really two, areas of fairly dramatic weakness that did not have a broader impact on the marketplace. And I'm hoping I'm catching your attention with this because it's not often that you're going to see the S&Ps, flat at the end of a trading session with the financials down just over 1%. And the monsters of tech are down just over 0.4%. This one, a big head scratcher over here. You know, you got to sit back. You got to be like, well, how can that possibly be? Your largest market caps are in the monsters of tech, right? This is Facebook. This is Apple. This is Microsoft. This is Amazon. This is Google. It's just that being down 0.4%, you would assume. All of a sudden now, we're seeing rotations of capital anywhere, anywhere to prop up those S&Ps. And again, this is highly unusual to see. You have a positive advanced decline line, again, with financials down over 1%. I'm going to show you a little detailed into financials because clearly this has been really the object of our affection kind of week in and week out. Well, we've carried a number of very key bearish positions specific to these financials. Now, we're going to come back to this in just a few minutes and do a little bit more of a market analysis here in just a few minutes. We're going to be looking at the SPX. We'll be looking at the financials. We'll look at the XRT, which is retail. We're going to look at XHB, which happens to be the home builders. We're also going to look at what opportunities, I think are right in front of us in both Home Depot and Lowe's. Before I get to that, there is a little bit of a bone that I want to pick with regards to upcoming earnings and earnings announcements. So we just hit end of the quarter, right? The quarter just officially ended. And when we come in, of course, on Monday, we're going to be trading in October. It's a bright new quarter. So at the end of the quarter, very often what you'll hear is people term this what they call window dressing. That is portfolio managers trying to dress the portfolio. And what they do is they buy up, good percentage performing stocks at the end of a quarter to dress the portfolio before mailing the statements out. I just gave you the the Cliff Notes version of window dressing. Now, I don't necessarily know if that's here or that's there, but this was a conversation and a topic of conversation amongst many emails and a lot of our clientele and going back and forth in the chat room about window dressing. But one key component came up, and here's the area I have a bone to pick with. A lot of people said, well, there's going to be outright selling starting next week. So, of course, I'll bite. Why do you believe that there's going to be selling next week? And the answer came back, because earnings are starting. And I go, oh, okay, so what? So, Apple has earnings a month from now. Like, I get it, right? And if you look at some of the banks are going to go first. The big banks, they go first. Goldman Sachs, they come like what? Mid-October. I'm ready, baby. Bring it. Most of the banks kind of go first, as I was saying, Bank of America, JP Morgan, Citi. So why is there going to be sell side activity in stocks that are going to have earnings? They said because the blackout period is coming. Okay, I'll bite. What's the blackout period? They said that's when a company can't do stock buybacks. And they go, whoa. Who told you this? Who said that a company can't do stock buybacks? With this blackout period, where are you getting this crap from? I mean, literally, this is the conversation we're having. So allow me to take you into a little bit of the quote-unquote rule book. All right, so in my previous life, again, I worked at, in trading in Chicago on kind of the professional side. After about 2 years, I joined a startup brokerage firm. It was called thinkorswim. Then we, took the company public and eventually were acquired by TD Ameritrade. And I went on for 5 years to run education for their 7 million clients. I am a walking, talking rule book. So I'm going to give you a little bit of the rule book right now on stock buybacks to end all of this, I'll call it nonsense right now. SEC regs regarding buybacks. Now, this is stock buybacks. This is when, Apple goes out and they're like, I'll take $1 billion. I'll take another $1 billion. Here's the SEC established rules governing the conditions under which companies can buy back stock. Okay, first, number one, firms cannot do so the end of a trading day. All right, in the last 10 minutes of a trading day, a firm can't buy back their own stock. All right, we got that one. That's rule number one. Rule number two, firms have to use a single broker for the trades. You're like, what does that mean? For the most part, most of these firms, like Apple, okay? Apple didn't hire somebody to be like, oh, what do you do at Apple? I am the guy that buys back the stock. They don't do that. They actually hire outside firms, okay? Somebody like Goldman Sachs is probably buying back the stock for Apple. In fact, they have to use, though, again, a single broker. So if they're going to use Goldman Sachs, they're going to use Goldman Sachs, period. Number three, firms have to buy back shares at the prevailing market price, okay? And they can't be more than 25% of the average trading volume over the previous 4 weeks. This right here, that rule is why they actually hire brokers. Okay, and they have algorithms that watch this stuff. But by the way, when it comes to SEC regs and regarding stock buybacks, let me tell you something. These are the only 3 rules. Yeah, you want to see some of the other things? Because again, this whole blackout period, it's all nonsense. Now, let me take it a little further. Let's get ugly with this. SEC regs regarding stock buybacks. Under a separate SEC rule, companies can do a share repurchase program even during a blackout period. Rule. It's called Rule, okay, 10b5-1 permits trading during the blackout period, providing the companies have set up a plan to buy back stock on a regular defined basis. Once again, right here, okay? That's why they hire an outside firm, because that way they can kind of wash their hands of it. And they said, I told you to buy back $20 billion this quarter. Get it done. And we don't want to know about when it's done, how it's done. The price, minimum, maximum, and amount of shares that are being bought back must be specified. You just have to specify within a quarter. In defining share repurchases plan, okay, once they define it, which they do, they make it public, right? Companies are afforded a safe harbor. That means you can't touch me. Insider trading accusations, you can't touch. It's safe harbor. So that is the rule regarding stock buybacks. But wait, there's more. Okay? In other words, a company and its executives can buy back shares during a blackout period, providing they are doing so according to a predefined plan. Now, most major companies, and I worked for, again, a public company, and was considered an insider and held in numerous shares. The executives, very often we did have a blackout period. We did have a blackout period, but theoretically you could get around it actually filing docs and using somebody to the outside. Nobody ever did. Nobody ever cared that much to do so. Kind of a naughty thing to do. And then you were allowed to trade again 48 hours After what? After the earnings period. The SEC does not mandate that companies disclose when they are using this rule. So it makes it impossible to determine what's going on. I just wanted to make this clear. Okay. So again, you got the rule right here. Okay. Again, the SEC defines that you don't have to disclose when you're using that rule. And we come to the fun part. Don't listen to talking market monkeys. When some monkey mentions blackout periods, you can tell them under rule, 10b5-1 of the Securities Exchange Act of 1934 to facilitate repurchases in accordance with the Common Equity Repurchase Program, a rule 10b5-1 repurchase plan allows the firm to repurchase its equity during periods when it would not otherwise be repurchasing common equity, for example, during internal trading blackout periods. Them's the rules, people. So anybody says anything about the blackout period, yeah, you throw them that rule, and you can look it up. It's kind of fun. Top 5 in stock buybacks in Q2 2018. Apple, again, leads the stock buybacks. Again, this was the end of Q2. They actually in Q2 had $21.9 billion in the second quarter. Okay, we had $7.5 billion of ABBV, Cisco $6.1 billion, Union Pacific $5.5 billion, and finally rounding out the top 5, Broadcom, which is $5.4 billion. This is buybacks, just the facts. Goldman Sachs estimates there will be over $1 trillion in U.S. stock buybacks this year alone, okay, which would smash previous records set right before the financial crash in 2007. Ooh, I love that statistic over there. And according to S&P Dow Jones indices, S&P 500 companies have bought back 4.4 trillion shares over the past decade, including the record-breaking buybacks from Apple. Apple alone, okay, is $250 billion. It is unbelievable. When you look at the market cap, 4.4 trillion. Okay, in shares, again, $250 billion coming from Apple alone. That's what I wanted to share with you in terms of stock buybacks before going into any more detail about markets, because, I don't want to hear the market's going to sell off because everybody's in a blackout period, because just the facts, it ain't true. It's just simply not true. All right, now let's get down to it. Hopefully you guys enjoyed that. Something a little different, something unique, but it's worthwhile discussing to, sometimes you have to cut through the fact from the fiction. All right, here's the SPX. The SPX, what did it do this week? Mild sell side activity. So we started the week at the SPX right around 29.30. Where did we finish the week? 29.13. It was a sell-off. No, it was a slow, painful grind that ended up down, 15, 16 points, and actually well within inside the expected move. This next week, that's the week coming, the expected move, okay, is plus or minus. It's right around $34. Okay, it's right around $34. So we're expecting about $34 in movement, which is very, very similar to the previous week. Okay, the week before that also similar. The week before that we had about a $42 expected move. But again, for those of you that are kind of keeping score right now, okay, this is about 25 weeks of data, and in 25 weeks we have three breaches of expected move at the end of a week out of 25 weeks. That's equivalent, again, for those of you again that kind of keep score on this stuff. When you're looking at standard deviation, this is about 25 of the last weeks. That's starting, okay, April basically 1st. So April 1st to right now, we basically have about 25 weeks, 3 out of the last 25 weeks. For the most part, what have we had? It's about 90% of the time we end up inside of the standard deviation. 90% of the time we're inside one standard deviation, which is shocking because it talks about the efficiency of the marketplace right now, okay, which is incredibly efficient at this point in time. Now, that's the SPX, again, mild sell side activity. Now, let's take a quick look over at the Qs. Now, the QQQ, I don't necessarily keep the expected move over here. So what I do is I use this little guy right here. It's the auto expected move. And in the auto expected move, the Qs this week, they did actually breach expected move just for a brief and fleeting moment and came back inside of it. That is of critical importance. The Qs, the Nasdaq, okay, ended the week higher. So the point that I wanted to make with this, first and foremost, is that the Nasdaq finished the week higher, okay? The S&Ps finished the week, mildly lower. You guys want to have some fun with this? You look at the Russell. The Russell actually, and I'll even pull up the auto expected moves in the Russell. The Russell breached the bottom of the expected move. So we had literally one index product, okay, that traded up. That was the Nasdaq. Another index product that listlessly fell, and the Russell gets whacked outside the bottom of the expected move. Okay, it makes sense that the Russell took a big hit. Why? Because of the financials. The financials, this is wicked. Okay, absolutely wild movement inside of the financials. The financials were expecting, okay, minimal move. Look at this. I mean, the expected move 29.16. The central point was about 28.74. I mean, the financials were expecting under, like a 50-cent move, and they ripped through. We're talking like 2.5 standard deviations outside of what was expected. This is what we'll term statistically significant. And the point that I want to make with the financials, though, is they breached in the previous week, and then they breached to the downside. Okay, so if you're looking for markets turning from efficiency to inefficiency, this is a place we better keep a really close eye on. The interesting point about the financials, okay, needs to be that the TNX, which is the interest rates have been flying up. Come on, I heard that was supposed to help the financials. Okay, is it? No, they've broken all correlation. Right now, the financials, they're their own animal. And what happens this next week is pivotal. At this point in time, here, my position, okay, I wear it like a badge of honor. I've been bearish in the financials for quite some time. All right, how's it helped me since the beginning of the year? It's been good. It's been good. I mean, since the beginning of the year, we actually initiated a lot of the bearish positions, though, when we were in the upper kind of 29 range inside of these financials. But on a year-to-date percentage basis, the financials are actually down now on the year. And they fell, okay, just over the last week, they've fallen over 5%. Now, specifically, we had, and we still have a position inside of the XLF. Okay, we had positions in Morgan Stanley. We rode Morgan Stanley down a good ways. Right now, the position that we have on, though, is inside of JP Morgan. It's doing very well. Again, JP Morgan is outperforming, okay, the other financials to the downside. And that's precisely why we initiated that particular position. Now, other interest rate sensitive areas. XRT. I'll continue to reiterate this. The XRT, probably right now, the biggest in terms of my, object of affection, because interest rates are flying higher, and we still have the XRT, your retail, up almost 11% year to date. It's still one of the better performing sectors out there. I think there's a wonderful opportunity. The opportunity, though, here isn't necessarily short term. This is one you got to get yourself embedded, okay? You got to get yourself longer duration. Okay, buy some duration. Use in-the-money puts. In-the-money puts. This is a bearish position. Buy in-the-money puts. Look for sell-side activity and roll as the thing starts to effectively sell off. Next one, okay? Now, XHB. I held positions in this, okay, for months. I currently do not have a position. But the point that I want to make with the home builders is, all right, higher interest rates. Then we got like Case-Shiller numbers weren't exactly what we expected. Anyway, they've been hammering the home builders kind of day in and day out. No pun intended, I guess. Hammering the home builders. Anyway, they're down about 13% on a year-to-date basis. So when somebody says, well, higher interest rates aren't necessarily having an impact, they should, and they should have an impact to the broader market, and you're feeling them right now inside of the XHB. But the XHB, you can't hop on this bandwagon. This is what we call shorting into the hole. Like, the hole is already being dug. So where can we go? I reiterated this last week, okay, and the week before that. Place like Home Depot. You could go to a place like Home Depot is at 207. Again, year-to-date percentage still up 10%. But Home Depot, okay, since we talked about it, is already off a little bit. It's already had some sell-side activity. So I'm not sure at this point in time that you want to, short it. What could you do? Okay, you can go over to Lowe's. Because Lowe's today, all right, here, why don't you back it out? 10-year all-time high, literally today, Friday, hits an all-time high, reverses off of it. It's ripe. It's ripe for the taking. And the kind of trade I want to build in here again is duration. Why am I all over these duration positions? Because it's where I see the biggest bang for our buck. Right? I'm all over like the 135 puts. I'll be buying the 135 puts at the open on Monday. I'll let the market open, dance around it for a while, but those 135 puts, not cheap. You're going to have to get a really good fill. The bid offer spread's a little wide in there, but it's a synthetic short position inside of lows. People, there's all kinds, okay, of chaos going on in terms of sectors. Money right now is looking for a home anywhere, okay, and you kind of feel like portfolio managers, they're willing to do anything to squeeze any edge or any alpha out of trades, okay? That unto itself are signs risk is bubbling up. Again, you know, if you told me that the financials would be down 1% and that the S&Ps would be flat, I wouldn't believe you. But if you told me that the financials are down 1% and the monsters of tech are off by almost 0.5%, and that the S&Ps would be flat, I'd say that's impossible. And that's why I'm telling you, okay, portfolio managers, traders, okay, throwing caution to the wind right now, and opportunities are coming. As these interest rates climb, okay, as the dollar all of a sudden retrenches a little bit higher, there's going to be some volatility in them there hills. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.